Today, I want to talk about how the biggest crash in history is about to start, with Jerome Powell predicting that more banks are about to collapse. I also want to explain how these banks are desperately trying to pump the market to avoid that crash. So stay tuned and let's make some money. I also wanted to correct myself. I said that yesterday was the best day we'd ever had in the Millionaire Mindset Trading Group. Well, today has absolutely blown that out of the water. We took a call option overnight on ARM, where Jeff locked in 2,888%, or $12,000 from a $375 investment. Crime Candle also tripled his account. We also had two stocks today that ran over 100% as well. But first I want to dive straight in with the key information. So, Unusual has tweeted saying Federal Reserve Chair Jerome Powell is predicting that more small banks will likely close or merge due to commercial real estate weaknesses, but that the problem is ultimately manageable. And typically when somebody high up says potentially manageable, that means potential all-out chaos. As Robert added, he said again, right on cue, just like some predicted. Jerome Powell cries uncle, and in a statement today spurs the word merger of small regional banks and potentially large ones. The fact that even Jerome Powell is word for word predicting that more banks will likely close spells bad news. This isn't even me clickbaiting or trying to read between the lines. This is word for word what Jerome Powell has just predicted. Obviously, I've spoken about bank collapses for some time now, but you also have to remember that banks don't just collapse overnight from nowhere. These collapses take time and have been continuing to get worse since March of 2023. As rates remain higher for longer, these banks struggle more and more. And now the next bank currently on the chopping block is NYCB, down over 60% so far this year. And as rates are still going to remain higher for longer until at least March or even May, many more banks will likely collapse, coming directly from Jerome Powell. But what's really interesting about this is this tweet from Endless Capital. So Endless tweeted saying, when money was free back in 2021, the S&P 500 didn't even rally with the steepness that it's rallied in the last 15 weeks. There was numerous pullbacks throughout 2021 and free money, but this year has been straight up for the last 15 weeks with the worst lending period or the worst interest rates seen in 15-20 years. He said, why has the market rallied so severely in the last 15 weeks straight up every single day with pretty much no explanation? Something doesn't add up. And the reason why the markets have rallied so significantly is because the banks are pumping the market to try and avoid margin calls or to try and inflate their assets so they don't end up collapsing. Now, obviously, you guys know what I think these banks are preparing for by pumping the market. Obviously, I think it's the AMC squeeze. But let's go for a different example that doesn't necessarily revolve around the squeeze. Finance Lancelot has tweeted saying in 2008, the collateralized debt obligation CDO market was $400 billion in derivatives before it collapsed. And right now in 2024, the collateralized loan obligation CLO derivatives market is currently valued at $1.25 trillion, 3 times the size of 2008. So even without directly saying the AMC squeeze, this collateralized loan obligation derivatives market is still incredibly overleveraged. This is the market that's currently struggling, the collateralized loan obligation market. That's why these banks are imploding, because the interest rates have gone up and these derivatives are getting worse and worse. And obviously, with these derivatives imploding, which by the way are 3 times the size of what they were back in 2008, these banks are struggling. And obviously, what kind of collateralized loan obligation derivatives do we know that really stand out? Well, it's those total return swaps. The total return swaps are a form of derivative and effectively a form of loan between 2 separate counterparties. Those collateralized loan obligations or total return swaps are imploding and causing these banks an absolute nightmare. And the only way they're currently surviving that nightmare is by desperately trying to pump the stock market as much as possible to inflate their stock assets. And obviously when the market starts to drop, because at some point the market does have to start dropping. I don't know if that's going to be next week, next month, in 6 months, next year, or whenever it's going to be. But when the market does start to drop, all hell will break loose. Something I talk about a lot in the Millionaire Mindset group is waiting for confirmation. So I'm not saying buy options right now on all of the banks and the stock market, but what I'm saying is prepare for the coming crash. And obviously when the crash does come, as I said, whether it's next week, next month, in 6 months, or whenever it happens, prepare for the squeeze alongside. I also wanted to go through those 2 fast-moving stocks that ran over 100% today, and they were CCTG and also SYRA. With CCTG, it set a pre-market high of $4.65 and then very quickly blew through that high and continued running. Shazad locked in a 177% gain, and Firefly sold half at 110% gains and left the rest to run. As I said, we also had a SYRA, which I saw at 3 minutes past 2, but some in the group saw it a minute earlier at 2 minutes past 2 and managed to ride the stock all the way from $3 to $4, all the way to nearly $10 per share. And as I said at the start of the video, Jeff made $12,000 on one overnight call option starting from just $300, and Crime Candle tripled his account. So guys, be sure to join the Millionaire Mindset trading group using the link in the description below. And speaking of which, Practical Stocks has tweeted about AMC Short Interest going absolutely nutty. So a week or 2 ago, I touched on AMC Short Interest, which was at 23 million shares or 230 million shares pre-split. Now that number has very quickly increased up to 29 million shares, or in the last 3 months, an increase of 144% shares shorted. Now you can argue and say, oh Tom, shares shorted pre-split and post-split are different because the dilution, but regardless of whichever way you look at it, shares shorted, the legally disclosed shares shorted in AMC over the last 3 months have increased 144%. And one could assume if the legally disclosed shorted shares have increased by 144%, then the illegal synthetic shares over the last 3 months have also increased by 144%. Over doubled, which again just proves these shorts are getting themselves into an even worse position by continuing to short AMC, desperately trying to push the price down every single day. Now on top of that, Kristen has also tweeted saying one of the oldest and best known hedge fund strategies has suffered nearly $150 billion in client withdrawals over the past 5 years, as investors tire of their inability to capitalize on bull markets or protect them during downturns. It's a well-known fact that many, if not most, hedge funds fail to beat the market every year, underperforming in bull markets and performing even worse during bear markets. So it's no wonder why so many investors are withdrawing their cash, over $150 billion in withdrawals. And it won't be long until at this rate, all investments are withdrawn from hedge funds, and many hedge funds do continue collapsing. Especially with the number of collapses we've seen over the last 2 or 3 years, we can tell from biotech Moose's Wall of Shame. And as more and more hedge funds collapse, every single collapse puts us one step closer to the AMC squeeze. So for every penny that's withdrawn from these hedge funds, it's just more and more good news for us. Now on top of that, you may have also seen that FINRA just fined Goldman Sachs for a failure to include warrants, rights units and certain OTC equity securities in surveillance reports that identify manipulative trading activity from 2009 all the way to 2023. 15 years of failing to identify manipulative trading activities, and all they got was a $500,000 fine. For a multi-billion, if not multi-trillion-dollar corporation to receive just a $500,000 fine for 15 years worth of crimes is ridiculous. You can see here it says from February 2009 until mid-April 2023, Goldman failed to include specific stocks, warrants and rights units in 9 of its automated surveillance reports designed to identify potentially manipulative proprietary and customer trading activity. basically specifically avoiding to identify manipulative trading activity in some specific stocks. And all they get for turning a blind eye to manipulation over 15 years is a $500,000 fine.